let's say, overlay something like the exponential growth of the wireless industry, that was a 20-year period when the number of users went from 37 million subscribers to 7 billion. And in the Global Crossing case, the second owner of the hotel made a lot of money.
Lee reinforces his bullish stance by advising clients to either hold or buy during periods of heightened fear, implying that downturns are typically buying opportunities. He frames his argument around a broader economic view. Unless one believes the economy is heading off a cliff, panic selling is irrational. Critical take: the buy-the-dip strategy works until it doesn't. History offers numerous examples, from the dot-com bubble to the 2008 financial crisis, where buying during early declines led to deeper losses before recovery. Lee's advice lacks nuance regarding risk management, diversification, and valuation metrics, all of which are crucial when deciding whether to buy into weakness.
More criticism than positive feedback to any of our views. I mean, if someone follows us on social media like Twitter, or if you look at the comments on our YouTube clips, or even sometimes unrequested inbound emails to our firm, usually it's criticism.
Yeah, it's amazing what people can do when it's anonymous, right? And they write in whatever. But those people, you've been right. I mean, you've been bullish, you've stayed long, you've stayed strong. What are you seeing maybe that some others are missing? I don't know.
Well, I think too many people are tied to their own biases. So like when markets were falling in February to April, then in their own portfolios, they were suffering damage. And as you know, that gets into people's sort of psychology because no one likes to lose money. It's more painful to lose $1 than the joy of gaining $1. But what we did was we took a step back and said, you know, with all the forces at work, are we really going to drive the economy off a cliff? And if the answer was no, then we know that at those points of fear, that's when, as hard as it is to do, is you either have to hold on or buy, and that was our advice to clients. You know, for instance, if we take AI as a thought, and we, let's say, overlay something like the exponential growth of the wireless industry, that was a 20-year period when the number of users went from 37 million subscribers to 7 billion. You know, we don't have 7 billion ChatGPT users, and we don't have 7 billion robots. So I think if not yet, that's right. And so if someone's trying to ring the bell at the top for AI, they're underestimating how quickly penetration grows. We're probably in the first quarter or first third of that cycle for AI.
Okay, if I had to take the other side of that trade, and who am I, but we'll talk about this, by the way, with Christina Partsinevelos coming up soon, is that people are spending a lot of money on AI, the Metas of the world, the XAIs, the Googles. They're buying a bunch of NVIDIA chips. They're building out power data centers, and all that's inflating the market. Are companies making any money from AI? They're spending a lot, but are they making any?
That's a great question.
Because if they're not, maybe they stop spending so much.
Well, I think that when you look at the early builds of any new wave, and I think wireless is a good example, first is the infrastructure that gets laid. So that's the LLMs and the data centers. And then what happens is you have critical mass, and so then the application layer starts to emerge. That's exactly what happened with wireless. And then that's when, not until 2007, that the iPhone came along, 15 years into that cycle. So I was
thinking more like Global Crossing-ish.
Yes.
Right? Somebody paid, and if you're really young, Global Crossing was a company that spent billions and billions and billions of dollars laying actual physical cable around the oceans, the world, to which eventually Global Crossing went bankrupt. But those cables are still being used today. Thank God.
Yeah, all that fiber.
They spent that money to do that, even though it sort of cost them the corporate entity. You're not seeing any of that now.
That's right. And in the Global Crossing case, the second owner of the hotel made a lot of money.
Yeah, second owner.
So I think that we're now at the phase where we're going to be thinking about things of like security around AI, you know, proof of human or whatever. And we're going to see companies leverage AI like the JP Morgans and the Goldmans. So there's another wave of opportunity coming where it's exactly what you're saying. We got to the point where AI is good enough that companies can really now actually improve their business strategy. So I think there's still a lot of positive to come.
Lavish begins with a bold but calculated statement. Bitcoin deserves a seat at the table in any serious investment portfolio. No longer relegated to speculative sidelines, he argues that Bitcoin is now a hedge against systemic risks, inflationary pressures, and fiat currency debasement. a theme that resonates deeply in today's macroeconomic environment. Bitcoin should one hold? Lavish suggests a minimum allocation of 2% to 5% of a diversified portfolio. This is not a random number, but a reflection of Bitcoin's asymmetric risk-to-reward profile. Bitcoin offers exposure to a decentralized monetary network with unique characteristics: scarcity, security, and global accessibility.
Just straight Bitcoin, it should just be an allocation to portfolios, and it depends on what portfolio you're allocating it to. But a minimum of 2, 3, 4, 5% in my mind is necessary at this moment. Now, as far as the early stage companies or venture capital companies and all that, what you're talking about, look, this industry has the same issue. It's not just the Silicon Valley startups. This has the same exact issue, maybe a higher failure rate, because it's such a new technology and everything's emerging and changing so rapidly. And I think that, one of our challenges and why we haven't done a ton of venture capital is because, we're trying to give returns to people that they'll be able to withdraw their money in 7 to 10 years, and have a great IRR over the course of that time. Now that means that we have to be careful about matching that timeline with that duration, with the duration of a early stage investment. Most early stage investments, Sam, take a long time. And they do not pan out. First of all, most of them don't pan out. You have to have, a couple of excellent returns, in the we're talking about 50, 100x plus, or you've got to have a unicorn, 1,000 something, you've got to have some sort of Google or Facebook in there. Low probabilities. I mean, there's been a long trail of failed managers that just didn't allocate properly. Allocate meaning diversify properly, manage a portfolio properly, and we've seen this over my course of 30 years how this can happen, or levered themselves to certain situations and not realize that their whole portfolio is levered to that one situation. But anyway, so it's just hard to match that 7 to 10 year timeline with early stage investments in Bitcoin, which are, I can see them at 10, 15, 20 year timelines. And so that's a mismatch in the duration of the investment versus the invested capital, the timeline of the duration of the portfolio. So it's a high hurdle, and it's typically you need to be further down the line for us.
Bitcoin is not dependent on one company's management, product roadmap, or business execution. It is a decentralized protocol with a 15-year track record, global liquidity, and an expanding network of institutional and retail holders. This makes Bitcoin unique compared to venture-backed startups in the crypto industry, which face execution risk, competitive pressures, and uncertain exit opportunities. For this reason, Lavish leans toward direct Bitcoin allocation rather than speculative investments in early-stage ventures, at least until the industry matures further.